What's going on, guys? If you clicked on this video, you want to know what the chances of you losing money in the market is. So I think this is a great question, and this is also a great video to be watching. So make sure you watch from start to finish, regardless if you just started investing today, a week ago, a month ago, a year ago, even 5 years ago. If you haven't seen the information I'm about to show you, I think it's very important for you to fully absorb what you're about to learn, because this has helped me immensely staying on track and sticking to my plan in the market, which has produced me some great returns. Okay, so the first thing that I want to show you, because you could just Google it yourself and it would pop up right here, 90%, according to a popular estimate, 90% of people lose their money in the stock market. This includes new and seasoned investors. This is wild. You're thinking, why would I ever invest in the stock market if there's a 90% chance of me losing? Playing blackjack or poker has better odds of you winning. So why are so many people investing in the market? And how come you always hear about these self-made millionaires in the market? What are they doing right that 90% of the people are doing wrong? Let's find out. Okay, so there was this famous study done by Merrill Lynch, and I remember when I first saw this, it was about 3 years ago, back in 2017. This study came out in 2016, and it's still true to this day. So if we jump on the computer, here it is. Here's the probability of negative returns for an investor in the S&P 500 for different time horizons. That's the key, time. We all know it's about time in the market. We all hear it. The longer you stay in the market, the more you make money. There's a saying, time in the market is better than timing the market. And it's very true, and you can see it right here. The chance of you losing money or ending negative in one day in the market is almost 50%. The market is pretty much random. So you have about a 50-50 shot of ending positive or negative in one day. But look at what happens. 1 month, it's a 40% chance. A quarter, which is 3 months, 30%. 1 year, 20%. 3 years is about 15. 5 years is a little over 10%. 10 years is 6%. You stay in the market for 10 years, there's a 94% chance you were ending positive. And here's where it gets really cool. 20 years. There has never been a 20-year period in the history of the S&P 500 that has ended negatively. That means if you started investing in 2000 and in 2020, you're positive. Same goes for if you started in 1980, by the year 2000, you are positive. Or 1987, that was the worst market drop in all of history. Over 20% in one day. Fast forward 20 years, you're positive. There is not a single point in the S&P 500 history where you would end negative after being in the market for 20 years. So it's right there. The chart is right there. It is so simple. Anyone can understand this. You could teach this to someone in elementary school. You say, hey, you want to make money in the market? Just put it there for 20 years. You will make money. That seems easy enough to follow. But how come 90% of the people can't follow this? And it's not just the new guys. It's also seasoned investors as well. The reason why is emotions. We can't control our emotions. We will see the market dip 10, 20, 30% over the course of a couple years. So with that being said, let's jump back to the computer really quick. This is the SPY ETF. And as we all know, back in February 2020, we saw the market take a nosedive because of the coronavirus. Now, if we just look here, $338 was around its all-time high, and it dropped all the way down to $220. It lost roughly a third. So for people who are just starting out, you have $1,000, $2,000, $3,000 in the market, whatever it might be. If you invested all of it in the SPY, and then it plummeted. Kind of sucks. You're out a couple $1,000s, but think about the person who's 45, 55, or 60 years old, and they have hundreds of thousands of dollars, if not millions of dollars invested in the market. You're gonna be hurting a lot more if you see your portfolio go from $1 million all the way down to maybe $700,000. You lost 300 grand in the matter of 2 months. That takes some people 6, 7, 8, 9, even 10 years to make. And they've been saving for decades now. That's when it gets really scary. They see this massive drop and there's no promise of what tomorrow is going to be. The market could continue to drop. We could enter a new recession. We could enter a new Great Depression. Anything could happen in the market. Nothing is promised in the future. And because of that fear of uncertainty, that's why people tend to lose money in the market. They'll have a plan, they'll stick to it, they'll keep investing year after year, especially if they started back in 2010. That was one of the best bull runs in all of history. You invest from 2010 all the way to 2020, you're just seeing your money grow and you think that you're a genius. But then something like this happens with the coronavirus and we drop 20 or 30%. Last time we saw something this bad was back in 1987. The only time worse than that was the Great Depression. So yes, this is very scary times and people get worried and they'll pull out of the market because of that and lose money. And then here's the worst part. We jump back to the computer, wherever people are pulling out and all of these red candlesticks you see, that's people selling. And they're probably selling a large percentage of their portfolio. But then look at this bounce back. No one would have ever predicted we would have bounced back that quickly, not even 2 quarters later, and we're almost at all-time highs again. Now, I'm not saying the market will continue to go up from here. It could roll back over. We could see new lows for the year because nothing's promised. But again, you can't look on such a small scope of time. If we zoom in and go back to those dreadful days during first quarter, this looks very intimidating. This looks very scary. How far it dropped. It dropped so low. The last time we were this low was back in 2016. If I scroll back, you could see, if we follow the dotted line, 2016 was the last time it was $219. So even me, starting in 2017, I've been saving money like crazy. I've been religiously putting away money every single month, if not every single week. And then I wake up one day and I see, wow, my portfolio is lower than what I started with. But I didn't sell. Instead, I started to buy more and I bought on the way back up. And now my portfolio is at an all-time high again. That's the thing. If we zoom back further and further, that massive drop looks less and less intimidating. So back in 2012, we were at $117. If we go back to a weekly chart, you could see this drop, even though it's still noticeable on the chart, it's nowhere near as scary as if you zoom in. When you zoom in and you see these massive drops, and it's not just here, it was here back in 2015 and 16 as well. 2008, of course, was its massive drop. 2001 was a massive bear market. That's much scarier. This is slow downturn, not something that's quick and short. This is a quick, painful ripping of the Band-Aid off. We go back to 2001. Thank God I wasn't old enough to invest, because watching my money go down slowly and painfully for 3 years straight, I give any older person props of staying in the market when something like that happened. And then they built all the way back up, and in 2008, they saw another year of downturn. That's crazy. We're fortunate to have these flash crashes because that's easy to deal with. You wake up and next thing you know, your money's down. You're like, all right, well, it can only go up from here, and it does. but slowly watching something tick down, that's really scary. But the big picture is the market always goes back up. And that's what you need to think about. You need to be in it for the long haul. Just remember, when you start investing, you're not in it for a couple of years or even a decade. You should be in it for multiple decades, 20, 30, even 40 years. Warren Buffett has been in it for about just under 80 years now. And that's why he's a multi-billionaire. He understood that it's all about a game of waiting. You got to be patient, hold on to great companies regardless of what the market is doing, because at the end of the day, you will get rewarded for being patient. That is the key takeaway in today's lesson. But that's all I got for you guys today. I hope you found value in this video and you learned something. If so, make sure to smash that like button, hit subscribe if you haven't already. And I'm curious, when did you guys start investing? Leave a comment below saying exactly when you started investing, what kind of plan you follow, and how do you control your emotions in the market. Other than that, I'll see you in the next one.